Hello, my name is Dr. Yaya Sissoko. Today we are going to talk about Chapter A, the determinant of deadweight laws and the tax revenue. So, what are the determinants of deadweight laws? So the deadweight laws depend on the elasticity of supply and demand. So, usually, if supply is more elastic, then the deadweight loss is bigger. If demand is more elastic, then the deadweight loss is also bigger. So what is an elastic demand or elastic supply? This means that the value of the elasticity is greater than 1. The absolute value is greater than 1. If the absolute value of the elasticity is greater than 1, we say demand or supply is elastic. If the absolute value of the elasticity is of supply or demand is less than 1, then the supply or demand will be inelastic. So, therefore, so the greater the elasticity of supply and demand, the greater is the deadweight loss of a tax. Figure 5 show the tax distortion and elasticity. Panel A is about inelastic supply. When the supply curve is relatively inelastic, the deadweight loss is of a tax is smaller. So you can see that how do you know that a supply curve is relatively inelastic? You can see the curve is going to be much steeper. It's going to be much steeper, meaning being close to be a vertical supply curve. If it's closer to being a vertical supply curve, then it's going to be inelastic. So you can see with an elastic supply curve, the so the deadweight loss is only the shaded area, and this is the size of the tax. Panel B deal with an elastic supply. When the supply curve is relatively elastic, the deadweight loss of the tax is larger. You can see that the supply curve is elastic. How do you know that supply curve is elastic? It's going to be the curve is going to be closer to be an horizontal line. So then you can see that it's much flatter. So if the curve is much flatter, then it's going to be relatively elastic. So with an elastic supply curve, the deadweight loss is very big. It's big in that case. This is the size of the tax. So in conclusion, the more elastic the supply curve, the larger is the deadweight loss of the tax. Figure 5 deal with tax distortion and elasticity. In panel C, the demand is relatively inelastic. When the demand is relatively inelastic, the deadweight loss of a tax is small. So looking at the graph, given the supply curve and the size of the tax, the demand curve is steeper. It's steeper, meaning the demand curve is close to a vertical line, and the demand being inelastic, the value of the elasticity would be less than 1. The absolute value of the elasticity would be less than 1, meaning demand is relatively inelastic. Because of that, the deadweight loss of the tax is small, and it's going to be this shaded area. On the other end, in panel D, the demand is elastic. When the demand is relatively elastic, the deadweight loss of a tax is large. So given the supply curve and the same size of the tax, you can see the size of the tax is the same in both curve. The the demand curve is elastic. How do you know that the demand curve is elastic? If you have a horizontal line, demand curve will be closer to the horizontal line, meaning that the demand curve is, you know, flatter. Because the demand curve is flatter, then it's going to be elastic. Therefore, the value of the elasticity, the absolute value of the elasticity of the demand curve in this case will be over greater than one. So, so the Deadwall loss in this case would be larger. You can see the Deadwall loss here is bigger than the Deadwall loss in the case of in inelastic demand. So therefore, here, if you compare panel C and panel D, the, the supply curve and the size of the tax are the same, but the price elasticity of demand is different. So we conclude that the more elastic the demand curve, the larger is the deadwall loss of the tax. Again, how big are the deadwall losses of taxation? So economists disagree that the government should not tax labor, so the labor tax. Example of labor tax are social security tax, Medicare tax, federal income tax. By preleving these taxes, this places a wedge between the wage that firm pay worker and the wage that worker receive. So example, the marginal tax rate on labor income is about 40%. And so meaning every dollar that worker receive, 40 cents go to the government and 60 cents is returned by the worker. The tax rate on the last dollar of earning in that case is very high, and which will discourage working. So the the impact of 40% labor taxes can be small or large, on the deadweight law. So it all depends on how elastic or inelastic is labor supply. Some economists believe that labor supply is fairly elastic, almost vertical. In that case, most people will work full time regardless of the wages, regardless of the 40% income tax that they have to pay. Therefore, tax on labor will lead to small deadweight loss. Look at this photo, taken during a presidential debate in the U.S. This is the candidate Barack Obama and candidate Mitt Romney. So, so the moderator of the debate asked, what's your position about the elasticity of labor supply? Because the elasticity of labor supply will determine how big or small is the deadweight loss. So if it's inelastic, like here, the deadweight loss will be small. So other economists believe that labor supply is more elastic. This would mean that taxes on labor will lead to greater deadweight loss because many workers can adjust the number of hours they can work overtime. Some family have a second, earner. They have a second, people working like a husband and wife or like kid work. Okay, so you have so in that case, you have some people, so they can decide they can work unpaid work at home. They work at home, they don't get paid, or pay work at the marketplace. So the many elderly people also can choose to retire. So so some other may consider engaging in illegal activity, economic activity. So because of that, labor supply might be more elastic, and in that case, the deadweight loss of taxing labor will be greater in that case. So as the tax increases, the deadweight loss also will increase. It's even more rapidly than the size of the tax, meaning that so the tax revenue increase initially, then decrease. So higher taxes dramatically reduces the size of the market because of the deadweight loss. Figure 6 deal with how deadweight loss and tax revenue vary with the size of the tax. In panel A, we have a small tax. A small tax will lead to small deadweight loss. You can see that that's a shaded area right here in that case. And and the tax revenue equal to Q time the wage of the tax, which is determined by the price PB paid to the buyer minus the price PS received by the seller. In panel B, we have a medium tax. Medium tax will lead to medium deadweight loss, so and a little bit bigger taxes. You can say the loss is a little bit bigger than the first case, and the tax revenue also is bigger than the first case. So panel C deal with the large taxes. Large taxes will lead to the biggest, deadweight loss. So, you can see that the deadweight loss is bigger than the first two cases, and the smallest tax revenue, from the two cases, because the bigger tax reduce the size of the market. So you can see that the size of the market is reduced so much that the tax raise only a small amount of revenue. To continue with figure number 6, how there were losses in tax revenue vary with the size of the tax. Panel D, from panel A and panel C, deadweight loss continually increases. If we plug the deadweight loss on the y-axis and the size of the tax on the vertical axis, the horizontal axis or the x-axis, we can see that the deadweight loss continually increases with the sac size. So as the sac size increases, deadweight loss also increases. On the other hand, in panel E, from panel A and C, we saw that tax revenue first increases, then decreases. So if you plot tax revenue on the y-axis or the vertical axis, and tax size on the horizontal axis or the x-axis, tax revenue will first start to increase as tax size goes up, get to a maximum, and then after that it will decrease. So, so this is known as, the Lafayette curve. And this is the end of chapter 8. Thank you.